Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. Today, I want to do a breakdown of two of the biggest categories that new investors tend to invest in, and that is blue chip stocks and penny stocks. Now, there are advantages and disadvantages to both, so we're just going to go ahead, break both of them down, give you my thoughts on what I think is best for new investors, and again, give you a straightforward pros, cons, everything you need to know within, let's try and do it in 10 minutes or less. All right, so what are blue chip stocks? Blue chip stocks, very simply, these are the cream of the crop, the biggest stocks, the biggest names. Any company that you can instantly name or drive down the street and see, it is likely a blue chip company. McDonald's, Walmart, Target, Starbucks. I'm just thinking if I just drive outside my neighborhood and what pops up, those are blue chip stocks. ExxonMobil, like these are the multi-billion dollar companies, usually international companies you know of, heard of, so on and so forth. The reason why they're blue chip is because they've been around that long. The advantage to you, if you decide to invest in any of those companies, is that they're relatively predictable. They're very unlikely rather, to go bankrupt. They are relatively predictable, and in some cases, not all, in some cases, you can get a dividend. An example is Walmart pays a dividend, Target pays usually a pretty solid dividend, Home Depot pays a good dividend, Lowe's pays a good dividend, Amazon does not. At least at the time that we are doing this, Amazon does not pay a dividend. So some do, most do rather, not all of them do. So that's blue chips. I mean, you know what they do? Easy to verify. They usually make a lot of money. That's blue chip. It's really kind of, mainstream versus kind of backwoods, which is where we are when we talk about penny stocks. Penny stocks are usually companies that trade at $5 or below, and usually quite a bit below. So in this video, I want to also kind of focus on one company just to give you an example of what a penny stock would be today. So Mullen Automotive, at the time that we're doing this, it's, I don't know, like 30 cents a share, which is not all that great. And this is by definition a penny stock. The danger of penny stocks is that they are, one, easily manipulated. So like I could come in and buy 1 million shares of the company and then tell everybody else to go and buy it. And then when y'all buy, I sell and I get to make off with money and leave. There are tons of scams of people that do this. They do WhatsApp groups, Instagram groups, Facebook groups, Reddit, and just really pump and dump. And that is one of the risks of these penny stocks, and they happen all the time, every single year. It's difficult to do that with a stock that's, I don't know, trading at $300 a share, right? Because that person, one person particularly, cannot buy up enough shares to manipulate the market in that way. But if it is super cheap, it is easier to do that. And the other reason why it's easier to do that is because there are no institutions behind it. When I say that, I'm talking about pension funds, large companies that create index funds like Vanguard, right? Vanguard owns billions of shares of the market, right? Of just the market. If you go and look at a Vanguard index fund, it owns Walmart. How many billions of dollars do you think Vanguard has in Walmart, right? I personally cannot outweigh Vanguard in trying to sway the market on buying shares of Walmart. But Vanguard does not own, at least in a huge fashion, shares of Mullen Automotive. Guess what? I could own the 1 million shares and move the market left and right and really profit on those swings. The problem is, number one, that's illegal, right? If I were to buy a bunch of shares and tell everybody else to buy and sell it, that would be illegal, especially if I benefited from it. The other thing too is it's highly volatile. This is why, depending on the app that you use, you will see a high risk sign or a high volatility sign, because any given day, these stocks can be up 25%, down 75%, and just be all over the place, which makes it very difficult for you to really decide if you should invest in it, when you should get in, when you should get out. I used to get questions all the time in 2020 when everybody was a stock market expert that came in and said, well, look, how do I know when I should get out of this crazy company? I don't know, man, because I don't know anything about them or what they can do or what we expect them to do in the future. It is super difficult to do that. Whereas if I'm looking at, I keep picking on Target and Walmart, I have no idea why, but Target, Walmart, Intel, IBM, those are easier because they've been around long enough, they have enough research. It's easier to say, okay, well, based on where we are in the market, this is what might make sense. Penny stocks are just out there. And then usually the other downside here is that not always financially sound. This is what it looks like for Mullen Automotive right now. These are losses. Okay, these are significant losses year over year, and that's not something that, in most cases, at least most normal people who want to make money in the market, that's usually not what people invest in. So you want to be very careful of those. How much should you invest in either blue chip stocks or penny stocks? If you ask me, hey, if you ask me, the answer is 0 in penny stocks. Okay, and now if you are someone who likes a lot of risk and you like to kind of gamble a little bit, that's just not me. Okay, I'm not judging you. That ain't me. So for me, it is 0, and for the clients that I used to manage and talk to, it was almost always 0. The other side of it, for blue chip stocks, you can invest as much as you want. However, still adhere to what I call the 5% rule. Whereas, let's say I can have no more than 5% in any one stock, blue chip or not. So that means that I can own a Walmart up to 5% of my money, own an Apple up to 5% of my money, so on and so forth. So even if I'm wrong, even though these are blue chip large companies, they can still lose money from time to time. It does happen. So if that were the case, I lost money on Apple last year, I made money on Walmart, great. Those things may balance out as opposed to be putting everything into one company and not doing well. So that is one of the ways that I would go through that process. I've done plenty of videos on how to decide what to invest in and how you split your money and all that kind of stuff. So that is what I would do if I were you, and obviously go back, like, and subscribe to go check out the other videos in case this is your first one. All right, now the last thing that you want to consider is just a regular plain Jane index fund. Okay, one that I always bring up is VTI, the Vanguard Total Stock Market Index Fund, or Index ETF to be technical. If you don't know what ETFs and index funds are, I did do a whole breakdown comparing the two of those. Aside from that though, usually these big index funds are almost all blue chip stocks. And I would venture to say all of them are all blue chip stocks. And there's a reason for that. And there's a reason why professional investors, people who get paid millions of dollars to manage portfolios and do all these hedge funds, 80 to 90% of them can't beat these index funds because it's hard to beat just plain Jane, regular, boring companies over the long term. I know it's boring sometimes, but it works. I'm not entertained by losing money, okay? I'd rather be bored and make money. That's just me. Don't know about you. That's just me. Okay. All right. So that is our video for today. If you want to learn more about the stock market, become a better investor, you want to make sure you are in our members only. We do deep dive, exclusive breakdowns each and every week. All right. That is it for me. I'll see y'all later.